So Getty is a net lease REIT specializing in acquiring, financing, and developing convenience, automotive, and other single-tenant retail real estate. Primarily, we provide direct sale leaseback or development financing to growing institutional tenants that operate a variety of national and regional brands, and we supplement that activity with transactions that are either brokered or marketed along the way. Today, we've got a national portfolio that's in 40 states of nearly 1,100 properties consisting of convenience stores, express tunnel car washes, auto service centers, and some other freestanding retail, which is primarily quick serve restaurants. We maintain a conservatively leveraged balance sheet. We've got an investment grade rating from Fitch, and we believe we've got a demonstrated access to capital. And we use that capital to fund our investment activity along the way. Our strategy is quite focused, and it's really predicated on us being experts in originating, underwriting, and executing real estate transactions in our target sectors. We believe that our knowledge of our target industries and long-standing relationships with many of the leading operators in our sectors is a real differentiator for us, and it leads to proprietary transactions that help us drive value for our shareholders. So Getty was founded in 1955 with the purchase of one service station asset in New York. From there, the company grew exponentially over the years and was primarily an owner and operator of its properties. In 1997, our founders split the company into two. So we had an operating company and a property company, which became Getty Realty. At that time, our real estate portfolio was really gas and service stations located primarily in the Northeast and Mid-Atlantic US. The results of our investment activities over the last 25 plus years is that we significantly diversified our portfolio and transformed the company into an owner of convenience and automotive retail real estate. Today, we've got approximately 1,080 properties, and as I said, we're in 40 states and Washington, D.C., and we look forward to continuing to grow and diversify that portfolio as time goes on. Yeah, great. Convenience and automotive retail real estate is really unique in the sense that we've got these essential properties which are e-commerce and recession resistant, and most of our operators have got a real long track record of strong performance and growth across various economic cycles. Within the C-store sector specifically, what you've got going on is chain store operators are taking market share away from older format or individual operators. And what we continue to see is really healthy same-store profit growth, primarily due to expanded food service offerings, the use of loyalty and rewards programs, and also increased fuel margins. If we look at some of our newer asset classes in automotive care and maintenance, again, what you're seeing today in the U.S. is the total number of vehicles in operation and vehicle age is actually, they're both at record highs. Within these sectors, again, you've got chains that are benefiting from increased brand awareness, membership programs, and using technology to improve their profitability. Yeah, great. Again, our retail properties are fairly differentiated in the sense that these really truly are essential businesses. Again, it's very hard to replicate it through e-commerce, and there's a long track record of performance across those economic cycles. Now, with that said, our property types are definitely dependent on the health of the U.S. economy and the strength of the U.S. consumer. So as investors, what we seek to do is mitigate that risk by performing detailed underwriting on our properties and also the tenants that lease our properties to. So more specifically, what we're really trying to do is make accretive investments in top 100 markets across the U.S. and make sure that all those properties pass our rigorous underwriting process. In the convenience store specifically, tenants really have to continue to be nimble and adapt their product offerings to meet the needs of the consumer. What we've seen is the sector has evolved quite well over the last several years. And today, the modern C-store is part traditional merchandise, part fast food, part grocery store. And looking ahead, with the presence of EVs growing, what we're seeing is increased focus on how to drive customer visits inside the store. And that means using technology and other programs to enhance in-store offerings, which tend to have higher margin products. For car wash and auto service, which are some of our newer asset classes, we've seen a lot of growth there as the consumers really embrace the concept of do it for me as opposed to do it yourself. And again, we seek to limit our exposure to these sectors by focusing on larger, more established brands. We've got a long track record of operating across various cycles. Well, I think we consider ourselves experts in the sectors we invest in. So there's certainly other net lease REITs that invest in some of our similar asset classes. But for us, the word expert really means that we've got a deep understanding of the fundamentals that are affecting our tenants and the properties that we own. We've got a database of thousands of properties that we've underwritten over the years, and we really use that as part of our underwriting process. We think it makes us smarter investors. We also like to think that our relationships in these industries really set us apart. We're often negotiating directly with CEOs, CFOs who are making long-term financing decisions. And many of those relationships go back decades, and we believe that track record of closing transactions with those tenants across cycles is really a key differentiator for Getty. Probably the last thing I'd say is, while we've been a public REIT for more than 25 years, we're really a fundamentally different company today than we were just even a few years ago. In our view, we're only a couple of years into this more comprehensive strategy of acquiring convenience and automotive real estate. We've made changes in personnel. We're investing in technology. And we really think we're positioning the company well to compete and grow as we look ahead. So while we're proud of our history and our portfolio and our recent performance, I think we're even more excited for the future of our business as we seek to grow and diversify the portfolio.